In many of our Power Options videos related to credit spreads, we discuss our preferred ideas for when to consider rolling or managing a position. The 1% rule: if the stock reaches within 1% of the short or sold option strike price. If technical indicators change when you originally identified the position, the criteria that you use reverse, and now the sentiment is bullish instead of bearish or bearish instead of bullish, you may consider an adjustment or exiting the trade. And of course, we look to close any position if we hit 50% of the maximum loss on the spread, the 1% rule. So this is simply taking a look at the short option strike price of the bull put credit or the bear call credit spread. If the stock reaches within 1% of the sold option strike price, for a bear call, that would be 1% below the sold option. For a bull put, that would be 1% above the sold option strike price. Consider adjusting or closing the position. The 50% loss on the spread. Whenever we open any credit spread or debit spread, we know the maximum risk. If the stock fell below both strike prices in a bull put credit spread or rose above both strike prices in a bear call credit spread, we would receive the full loss on the position. The maximum monetary loss is the difference in the strike prices minus the net credit that you received, times the number of contracts times 100, of course. We look to close the position when the liquidation loss of closing both legs equals half, 50% of the maximum loss we could realize on the credit spread position. Again, the stock technicals: if the trend you used to enter a bull or bear spread reverse, whether you use a stock trading above a 20-day, 50-day, or 100-day simple moving average, whether you use MACD or Bollinger Bands, whether you use stochastics, when those trends start to reverse, consider exiting or adjusting the trade to a position that matches the new sentiment of the stock. Now, Kevin needed some clarification. He asked us, regarding closing credit spreads, do you close them at the 1% rule? Or do you close them when they are down 50%? As an example, today, the DraftKings DKNG bear call credit spread sold the 53 strike, bought the 56. The stock was trading at 51.65, but the option, which expires next week, is down 87%. We're not within the 1% rule yet, but an option is down 87%. So Kevin asked, can you please review the suggestions for the best time to close a spread? Now let's go back. On June 21st, DraftKings closed at $49 per share. For the July 2nd expiration, coming up this Friday, the 53-56 strike spread that could have been entered with 11 days to expiration, we could have sold to open the 2nd of July 53 call at 57 cents and bought to open the 2nd of July 56 call for 27 cents. We'd receive a net credit into our account immediately of 30 cents per contract times 100, and the maximum risk in our 3-point spread, difference in strikes of 3 points minus our net credit, is $2.70. This would give us a potential return of 11.1% as long as the stock stayed below $53 per share, July 2nd expiration, and both calls expire worthless. Let's break down how we would set the mental or strategic stops for this particular position. The 1% rule. We sold a 53 strike call and bought a higher strike 56 for our bear call credit spread. 1% of that 53 strike, of course, is 53 cents. In the bear call spread, we would set the stop below the sold call, the difference of the strike price that we sold minus the 1% of that option before it goes in the money. We don't want the stock to go above 53, up to 53.50, 53.60, 54, and so forth. We want to look to adjust or potentially close the position if the stock reaches within 1% of our short option strike price. So in this case, 1% rule, we'd set the mental stop at $52.47. 53, the strike price of our sold call, minus 1%, 53 cents. Technical indicators. Regardless of what you use, when the stock starts to change direction, if those technical indicators start to change, whether it's something just as simple as a simple moving average, you entered the position when the stock was trading below the SMA 20 or below the SMA 50, and now the stock has started to move above it. Whether you use MACD, whether you use Bollinger Bands, whether you use stochastics, when the trends that you use to find a position that matches your sentiment reverses, you might want to consider exiting or adjusting the position to match the new sentiment on the trade. Now, regarding Kevin's direct question, 50% loss on the position. Kevin had said, as an example, the DraftKings 53.56 is at 51.65. It's not technically at our 1% rule. But the option, which expires next week, is down 87%. Looking at the position today on June 30th, had we entered this position on June 21st, we see here on the Power Options portfolio that our July 56 call, the call that we bought, not the one that we're worried about, but we paid 27 cents for it, and it's now down to 6 cents. We're losing 77.8%. But the 50% loss does not apply to any individual option in the spread position. What we're focused on is the liquidation value of the entire spread trade. If that liquidation value, doing the opposite transactions, if we bought to close the 53 call and sold to close the 56, and that liquidation value was technically half, or a little bit more actually, of the maximum risk of 270, that's when we would look to close the position. At this point, the stock trading at 52.17, it's not at our 1% rule. We only have 2 days to go to expiration. We collected a 30-cent net credit on the position, and if we closed both legs right now, it would cost us 32 cents. So we'd lose 2 cents, or roughly a small percentage of the maximum risk that we could incur. We're not concerned that the 56 call is down by more than 50, 60, 70%. In fact, that means the spread is likely going in the direction that we want. And if our 53 call is 50% profitable, 40% profitable, 30% profitable from what we sold it for, and now it's decayed in price, that's what we want to have happen as well. The 50% rule means you would look to liquidate this credit spread, bull or bear, if you've hit 50% of the maximum loss for the entire spread position. Using the closing prices on June 21st, the DraftKings bear call spread 53.56 took in a net credit of 30 cents with a 3-point spread. The maximum risk was 270. If the stock was trading above $56, we'd be obligated to deliver shares of stock we don't own at 53. We have the right to buy them at 56. Our broker would handle that for us. We'd come out with a $3 loss in the position, but we keep the 30 cents. So the max loss is only 270. We're going to look to close the position when the liquidation loss is half of the maximum loss, or in this case, $1.35. Not the liquidation value, because regardless of what happens, we keep the 30 cents that was deposited into our account when we opened the credit spread. The liquidation value in this case would be 165, meaning the liquidation loss would be 135, or half of the total credit spread position. In review, the 1% rule is more of a mental stop. It's not a hard stop, in our opinion. If the stock reaches within 1% of your short option strike price before it goes in the money, you may consider adjusting the position, closing the position, of course, if you think your sentiment has changed. Other indicators here have been matched as well. Meaning that if the stock has shifted, and in DraftKings the stock hit the 1% rule, and the technical indicators that I had used to open the position have reversed and now look bullish rather than bearish, if two of those are true, I may consider closing the position. You want to watch for a reversal in your initial guidelines that you used to enter in the sentiment of the trade, bull or bear. And the 50% loss guideline is a 50% loss on the entire spread. When we liquidate the entire spread, if the loss we would take, the liquidation loss, not the liquidation value, but the liquidation loss is 50% of the most that we could lose, that maximum loss, the difference in strike prices minus the net credit. In our example, when the liquidation loss hit $1.35, half of the $2.70 of the maximum loss, that would mean we'd be exiting the position at that point. That is more of a hard stop rule for our approach to credit spreads. It doesn't have to be your approach. You may have other stops that you use, common things that are also used, or if the liquidation cost is 2 or 3 times the initial net credit received. Our approach that we use for the bull put weekly spreads and for other spread positions is the 1% rule, the 50% loss on the spread, and if the technical indicators change. The 1% rule and the technical indicators are more warnings, mental stops, considerations that I may want to start thinking about adjusting or perhaps closing the position. But if that spread hits the 50% loss of the maximum loss I could lose, if the stock went above or below both strike prices, that for us personally is a hard exit and we would get out of the position. For other information, of course, on managing credit spreads, trigger points for credit spread positions, bull or bear, check out our YouTube channel. Just go to YouTube, search for Power Options. Do a search there in the video sections for bull put or bear call, and you'll see a list of videos. For bull puts, the full presentation, 8 ways to manage a bull put credit spread. In the first 10, 15 minutes or so discusses these trigger points as well. And then, of course, the 8 ways that we might consider to manage a bull put spread. A quick review, 12 minutes and 30 seconds long, tips on when to exit a bull put credit spread. Just looking at some ideas again of when we would consider exiting the position. And another video there, about a year ago, bull put credit spread triggers, management criteria, and then some other discussions on other strategies as well. But as I mentioned, you can also scan for bear call credits, bear call spreads to see ways that we might consider doing that as well. But in either credit spread, our approaches, these 3 rules apply. This is a review for Kevin to clarify the 1% rule, the technical indicators, and most importantly, the 50% stop, which is based on liquidating the entire position, not an individual option in the spread. And once more, these are our approaches and what we use for our spread positions. Hopefully they help you out as well. But of course, there are many different ways you might consider managing a spread position. This is just what we found works best for us and our approach with the credit spreads. Thank you for watching, and we'll see you soon.